Okay, hey guys, what's happening? It's a live stream. It's another episode. Can you believe this is episode 35 of the Wealth Circuit Investing Hour? You know, we started this, gosh, when was it? Back in the fall, I guess, of last year. Or maybe it was closer to Thanksgiving. But anyway, we started quite a while ago, and I thought, well, I'm going to try this and see, and I'd really enjoy it. So, but what makes this successful is you guys. So I'm really happy to have you guys on board with this program. And so we're going to go ahead and get kicked off here. Um, let's. I'll talk real quick about one of the questions that came in. And let me get that kind of. I had some technical difficulties before before I came onto the show, so I'm running a little bit behind, but that's okay. We'll just kind of make it happen. So here we go. This is. Let me take this off. Get that. Take that off. There we go. Now we can see everything. Episode 35. Man, it is hard to believe. We are going to talk first of all about a question that came in. This question came in from Mr. Income. If he shows up in the program, he will be, I forget, he's got a different handle on the program. But anyway, if he's on there, I will certainly let you know. Let's see. Yeah, I don't see him in here yet. So, anyway, he'll come up. But anyway, his question was, I've always thought gross margins formula is revenue minus cost of goods sold is gross margin. Is that correct? And yes, the answer is that is correct. So gross margin is what you actually sell your product for minus the cost it takes to make that product, to manufacture or to produce that product. So that's your cost of goods sold. And therefore, gross margin is revenue minus cost of goods sold. So if yes, then the only reason to have or project negative gross margins is heavy discounting to clear excessive inventory from the channel. Inventory has a shelf life, or you are currently paying interest on it, etc. Or can you think of another reason? Well, that certainly is one of them. I mean, if a company has a lot of inventory. Let's take Stanley Black & Decker, for instance. They had a lot of excessive inventory, so they ran specials, they ran deals. They recorded obsolescence, which is where the inventory, they just go ahead and write it off. They get what they can for it, or they give it away, right? So that's one way. When they actually record that obsolescence, it goes against cost of goods sold and creates less gross margin. So, that's certainly one way for it to happen. Another is if you don't have price elasticity, and you're I don't know if that would cause a negative gross margin, but if you don't have price elasticity, then your costs may go up, but you can't raise the cost of your product because your customers won't buy the product. They have either they'll either go without, or they will have some substitute in place. So that would be the only other thing I could think of. So I'm not really sure what the specific situation is, but hey, the question is a good one. And so, yeah, that's the only thing I can think of other than, just price elasticity. So there you go. So the other question that I got was from actually a couple of people in the Discord. So that brings me to a point. If you're not a part of the Discord and you want to be in a group of folks that kind of get together and chat about investing, feel free to join us. There's a link in the comments below. We talk about a lot of different things. As a matter of fact, what you see here, maybe I could even make that bigger. This question that you see here was actually posted in the Discord from Mr. Income. So we have, it's basically a chat room, kind of a modern day chat room, and we keep things organized by categories. And so we can talk about a lot of different stuff, and it doesn't get confusing. So if that's something you're interested in, join us there. I'm going to go ahead and get rid of this though. because, yeah, I'll save that. Because we are going to share about Prudential. So a question came up from a couple of guys. I think it was ex-dividend dad and then NK. I think he goes by a couple of names as well, but NK. So both of them were wanting to know about Prudential. So they wanted to do a deep dive. So I don't know if we'll do a deep dive, but we're gonna delve into that. I'll just show you guys how I look at stocks. So hopefully that'll be helpful. So let's start with Prudential. I'll go ahead and share my screen with you. And when normally I like to have like a presentation and stuff set up for you guys, but if you knew how close it was for me to actually get my computer up and running just for the program tonight, it was kind of scary. So yeah, so I'm going to share this screen here. Okay, so here we go. So this is Morningstar. I'm not going to look at Morningstar right now. The first thing I typically do when I'm looking at a stock is I will go to Simply Safe Dividends. I will look at, things like, and let's say that I don't know anything about Prudential, and that's not the case because I used to own it. I sold it off here, I don't know, maybe a month or so ago. Made a nice little profit on it. When I sold it, it was around $124, $125, something like that. It has come down very quickly back to 108. But let's say I don't know anything about it. There's dividend safety score 75. They've got a dividend yield of 4.8%. That tells me that one of two things. Either there's something wrong with the company and investors have pulled away from it for some reason, or the investors are not thinking it's going to grow very much. And so therefore it creates a bit of a yield. So, hey, 4.8% yield is a pretty nice yield. Matter of fact, that might be attractive for me to re-enter Prudential. But then I go down, I look at their payout. Well, so then I look at their annual dividends. They're up and to the right. They've done a really nice job over the last 15 years of uninterrupted dividend growth. And then I go down and I look at some of the metrics. Their earnings payout ratio actually looks pretty good. In 22, it had hit a 51%, which is, pretty close. But now next 12 months, they're looking at 37%. That's fantastic. Earnings per share is growing. And let's take a look at their share. They've been buying back shares as well. Return on invested capital is not that impressive. So take a look at this. It's 6%, and for the last 12 months, that's not blowing the doors off of things. But sometimes for a high yield company, that's kind of what you get. Net debt to capital, that's the one I look at. I don't look at net debt to EBITDA or if they have any more in here. I typically don't look at those. I do like looking at net debt to total capital. 37% of their capital is debt. Interest coverage, they don't have any. Huh, that's weird. I don't see a slide that shows their net debt either. So, but anyway, so that piece of information is missing. So that'd be something that we would want to look at. Then what I do is I will typically go to their last earnings, report, which is right here. So this is their August 2nd earnings call. You can see that, they got some key messages. And I think one of the issues with Prudential is that what they say is very confusing. I know I've been confused by it, so I'm sure others are as well. So their key messages are they want to grow and they want to grow their market leading businesses. That don't tell me much. What are your market leading businesses? They want to maintain disciplined capital deployment. Don't we all, right? Even in our portfolios, we want to maintain that. So neither of those are very explicit. And then they want to, they're supported by their rock solid balance sheet. Well, that's great. So, even those key messages don't resonate with me because it doesn't really tell me anything about Prudential that some other company doesn't want. And then they've got this cute little phrase here: we make lives better by solving the financial challenges of our changing world. That means absolutely nothing to me in terms of their business. So then we go a little bit further. They're growing their market leading businesses. So you can see they've got business in the U.S., they got international, and then they got PGIM, which is where they manage other people's money, these retirement accounts, and things like that. So maintaining disciplined capital, they returned over $700 million to shareholders. So all of that's good. The rock solid balance sheet. They got AA financial strength, so that's good. They've got liquid assets of $4.4 billion. That's also very good. Then the rest of that's just words. Then I go and I look at the highlights and I see, their PGIM business is growing. Their U.S. businesses are growing. Their international businesses, however, are down about 10%. So then when I go to PGIM, I notice that PGIM's only about 10% of the company. So probably not something I want to spend a ton of time on. However, I look at the U.S. and it is 50%. The challenge I have with Prudential is that 50% of the 50%, which is 25%, is something called net spread. And this is the part that gets a little confusing for me, because net spread could mean a couple of different things. It could be credit spreads, or it could be, and I think this is really what it is for Prudential. So if you think about it, Prudential's an insurance company. So they get money in from their folks like me. If I happen to have Prudential insurance, I would send my check in to Prudential. Prudential would cash that check and they have those funds there. Let's say it's life insurance and I'm still around, still kicking. So they're sitting there with these premiums in an account, and they're trying to grow those premiums. So the spread could be the cost of these programs that they have. And it's not just life insurance. It could be, anything. It could be any program that they have. So there's a cost associated with that program. There's then, the money they make on those premiums, and that could be the spread that they're talking about, although they don't really say, and it's really difficult, I think, to follow that. So U.S. businesses, half their income, and half of it is net spread. The rest is easily understandable. The underwriting fees that they have is 19%, and net fees just for carrying the programs is 31%. I get those. The net spread's a little bit hard to understand. And then 40% of the business is international. Most of that is Japan. So they have updated their assumptions then for the third quarter. And it looks like things are growing a bit for the third quarter. And I think those are the main things. Retirement. Yeah. So these are segments. They've got a lot of segments. So I'll just kind of scan through this and look for anything that looks kind of interesting. Then I will go over to Morningstar and I will ask Morningstar, what do you think about Prudential? And so they will come up on the screen and it'll say, hey, we think it's a 3-star. It's trading. It's a fair value of 108. It's trading at about 109. It's actually 108 something, I think, today. 108.40. So it's in a fair value range. Probably not anything exciting. So it doesn't get me too excited to get back into Prudential at the moment. Then I'll go over to tip ranks. I want to see what the analysts are saying. Analysts are saying that it's they could be at 122. 0.7, which is about a 13% upside. It got up to 124 when I sold, 125, something like that. So I think, that's probably a reasonable assumption. But I just don't know that Prudential is. I don't understand Prudential well enough to, I don't know, to get back into it. So, that's Old Dominion. Let's look at Prudential on Fast Graphs just to see historically where they've been. And you can see it's trading well below what Fast Graphs would consider a value for the business, which is this orange line. But they historically trade low. Look at this. That blue line is where they historically trade. And they're even a bit below that. So, it's certainly reasonable. Let's see what would happen if it went back to where it normally trades. Be about a 21% return per year. So that's not terrible either. But I tell you, there's just not a lot exciting me about Prudential. So ex-dividend dad and NK. Hopefully that was worthwhile. And so I think now we'll go to the broadcast here and see who all is on. Let's do some shout outs here. We got Fast Eddie. Fast Eddie is in the house. We got Jim. Jim has joined us. And if you don't follow Jim on Facebook, you should. He's got a lot of good stuff that he puts out on there. El Dynamico, Antonio is with us tonight. Good to see you, buddy. And Jacob Harrison is here. He says, hey, y'all. Must be from Alabama. So, hey, y'all. Michael Swami is here. Good to see you, bud. Oscar has made it. I haven't seen you in a few weeks, Oscar. It's good to have you back, man. I'm breaking up. Hopefully not. Hopefully you can hear me. Greg is in the house. Good evening, my friends. Good to see you. Brad Durfee is here. Man, we've got a good crew tonight. Rust Moments is here. Yo. Hey, man, it's great to have you here. Pat is in the house. I knew Pat would make it. He mentioned it last night. So we got ex-dividend dad. Hey, Mr. Prudential is in the house. Good to see you, my friend. Billy says he owns Prudential, PFG. I'm going to have to look that up. Let's see what PFG is. We'll just do it together. I see you can see my screen. Principal Financial Group. Okay. I'm not familiar with them. And MFC is that Manulife Financial? Yeah, Manulife Financial Corp. So that's good stuff, man. They've all done well. I'm a believer, he says. That's good. That's what it takes, man. Sometimes we just we invest and we just got to believe. So there you go. I'm going to get those things off the screen there. There we go. Okay. Jim says Prudential stock price took a dump about the same time their earnings report came up. Yeah, that is exactly right. So apparently you weren't the only one confused by their presentation. Yeah, I think that's right. I just don't. I would rather a company be just straightforward and tell me what's going on, good or bad, so that in a way I can understand it. If you give me a lot of consultant speak and a lot of words that just don't mean anything, I just get bored with it and I feel it's time to move on. So Jim says he got MFC in the insurance space. How does MFC compare to Prudential? That's a good question because I don't tend to follow them. But what I can do is do a just very quick. That's interesting. I'll share that with you guys. If I can find my cursor. There it is. Looks like Manulife is a 49, borderline safe. It's got a dividend yield of about 4.6, so very similar. I think Prudential was 4.8. Let's take a look at their dividend growth. That looks pretty good. They had a little struggle back in 21, maybe. So I don't know. And they're in Canadian dollars as well. So yeah, they actually, I don't know. I don't know if that, I can't tell if that's flat or if that they actually decrease the dividend, but it does say that the growth streak is only 2 years. So maybe it didn't decrease. Maybe it just stayed the same. Maybe that's what it is. So yeah, I don't know. It looks like, at least from a dividend safety perspective, looks like Prudential wins over Manulife. So that's hopefully that's worthwhile. I don't know. Slammer 6789, you made it, dude. It's good to see you, my friend. Yeah, so that's a great question, Brad. Do many companies talking gibberish like Prudential seems to? There is one that comes to mind. It's been a couple of years ago, so I have not played around with this company since maybe a couple of years ago, maybe even 3 years now. But it might be cool, and I know some of you may own them, and it's okay. I'm not mad at you. Don't be mad at me. But there was a company that I listened to their earnings call, and I was really excited about them. And I listened to the earnings call, and it was just like I could not understand what they were saying. It's like there was, I mean, I heard the words, but the words didn't really mean anything. And they'd just gotten a new CEO, so maybe I need to give them a little bit of grace. But it was Clorox. Of all companies, it was Clorox. Clorox, seems to be something that would be pretty easy to understand. How much bleach do you sell? How many garbage bags do you sell? I forget, what all they sell, but they're pretty diversified in terms of products. So but when they would talk, and I would just go, I don't have any idea what they're saying. So it's about that time that I said, no, I'm not investing in them. And it wasn't long for their stock dropped significantly. And now they have come back, and I think they're kind of up and down at this point. But Clorox, Brad, might be the other one. I don't know of others, but I can tell you that one really got on my nerves. Oh yeah, Jim, thanks for the Facebook shout out. The Dividend Stockyard for anyone interested. Absolutely. It's great, man. Let's see here. Jacob Harrison, so true, especially when it comes to learning. Maybe I missed that. Oh, he's responding to the better late than never. And yeah, no, that's right. We've all had a little bit of learning issues, as I know I have this past quarter. Let's see. Michael Swami, Starbucks post earnings interview was gibberish. Yeah, that's a good call. I didn't watch that. I kind of gave up on Starbucks when they can't seem to find a CEO to replace the I forget the original guy's name, but we've got a plan to deal with that. So evidently that's their mantra is, yeah, we've got a plan to deal with that. We're not sure what the plan is, but we got a plan. So, my buddy Russ, thanks for the Pru info. Was driving home and listening. I've been mulling over selling my 32 Pru shares, average 75.90. Yeah, no, that's good. I don't know, man. I don't know. 108 is a fair value. So I don't know that it's screaming for a sell, but I don't think it's screaming for a buy. I would rate it as a hold, but you got to do you. And if that's something that you want to move into a different investment, hey, nobody faults you for that, man. That's good stuff. Let's see. Jacob says, what I'm hearing is a company with no nonsense speak is more trustworthy. I think that's right, Jacob. Yeah, I mean, that's just the way I like communication to be. I want to be straightforward. You can hurt my feelings. I don't really care, but be straightforward about it, right? And yeah, so I'm with you on that. So Russ here says also their combined ratio is 1.42, which is no bueno. I'm trying to think of what ratio that would be. Cool to hear. We share many of the same thoughts on Prue. Yep, no, that's great. It's what do they say? Great minds think alike. So there you go. So Jim says, I love it when Kramer has a CEO on his program and he starts talking gibberish, and Kramer usually calls BS. I seem to remember, and it might be worth looking up because for the entertainment value, if nothing else. I seem to remember the Clorox CEO being on Jim Kramer. This has probably been a couple of years ago when I was looking at them, and she just got pummeled by him because it was just that gibberish. So yeah, this is good. El Dynamico. The original Starbucks CEO was Howard Schultz. Yeah, that was the name I could not bring up in my brain. So where are we going to go from here? So we did questions for Kevin. We did Prue. So now it's about, what do you guys want to talk about? Are there any stocks that are top of mind? It's kind of interesting. Now that I have my computer back, I can actually pull stuff up and look at it. I heard of so my computer shut down, so I'm getting some messages here that say you've got. Yeah, I'm gonna save that. I'm doing document recovery here, so sorry about that. Here, we'll save that. Okay, I think we're good now. So now I can pull up the file I was going to pull up, because what I was going to tell you guys, sorry about that. What I was going to tell you guys is there's a couple of new stocks that I have added to my watch list that I thought might be worthwhile for you guys to take a look at. One of them is I wish I had a field here that says when I added it to my watch list. Now I've got to go through all of them. Here's one, and I heard this from my buddy Ari Gutman. If you guys don't listen to him, you should. He's got a really good program. It's called Amphenol Corporation, APH. I have it on my watch list. I have it as a hold, but it is basically a electronics company that sells electronic equipment to multiple different industries. So it's something that it looks really good. The financials look good. They had a blowout quarter, and so I think really what holds me up is they seem to be over fair value significantly, like 12%. So I'm kind of holding off on that. Let me get rid of Manulife here. There we go. So I'm holding off on Amphenol. APH is the ticker. So that's one, if you want to take a look at that. And who is the other one? There was one other that I added. Oh, I added Waste Management, but it's not that exciting at the moment. Yeah, so those are the two. Those are the two I added. So right now I have 50 stocks on my watch list. So that's quite a bit to kind of keep up with. So I've been creating, I'm going to do a video on this. I've been creating a way that I can kind of rank which of these stocks should rise to the top of my watch list. So rather than going through each one of them every day going, oh, should I buy this? Should I not buy this? I'm coming up with an algorithm that would be something like the NFL draft, so that we can see which player is the next best player, regardless of position. So regardless of whether it's a value stock, dividend growth stock, or high yield or dividend yield stock, I want to see which one's the next best player. And I have it built and I've been using it, but it's one of those things that takes a while. It takes a long time for it to actually play out. But I will do a video on it just to kind of describe it, and hopefully it'll be something that I keep for the long term. Let's see. I think I got lost here. There we go. Here I am. Oh, Michael Swami says the Starbucks CEO was on Kramer and got killed. So that's not good. You know, if you're a CEO and you know, you either have to say things are bad and here's what we're doing to fix them, or you have to say, I don't know what I'm doing. And evidently, he didn't know what he was doing. Let's see. Russ is describing the combined ratio, shows how much money an insurance company spends on claims and expenses compared to the premiums it collects. I gotcha. Oh yeah, if they're spending money more than they're bringing in, that's not good. Yeah, that's weird. That's weird. I wonder how that matches up with the relatively high dividend safety rating, though. So maybe that was the issue. Over one is bad because it means the company is spending more than it's earning. So yeah, that's not good. I did not realize that Prudential was having those kinds of issues. So let's see what Jim says here. He's got a thesis going on. Not sure if me, Russ, or Ryan are talking about the art of quality investing. I picked it up and it's a good read so far. Thanks to ? So that must be a book called The Art of Quality Investing. So we will have to look that up. Maybe I'll just do that now because I will forget. The Art of Quality Investing book. There it is. It's on Amazon. Here, I'll show you this. So in case you want to order it, it's on Amazon. It is, I don't see an author though. Oh, there he is. Luke Crow. I don't know how to say that. Kroeze. Crows. I don't know. So I'm probably butchering that, and I don't mean to. I don't know. I've never heard of his name before. The Art of Quality Investing. Cool. Let's I'll take a look at that. That might be something that I add to my list. So good ad there, Mr. Jim. Appreciate that. All right. So here we are. We are at 33 minutes. And we got time for a bunch of stuff. What do you guys want to talk about? What stocks are you looking at? I will tell you that you know, I have started trying to recover my Lamb Weston debacle, and so you know, I bought some shares last week when the you know, the market crashed in the early part of last week. So I picked up some Lamb Weston shares at 55.20. And now it's trading around $60. Let me see. Here it is, $58. It went down today. Went down $1.83 today. So anyway, so hopefully at some point, it might take me a few years, but I do plan to get that back. I'm hoping to get that back, and I'm hoping to use Lamb Weston to do it. It is still, you know, it looks like it's going to be a stock that in the long term, and you know, if you have a long-term view of the market, I think in the long term, they're going to do okay. But this is just a tough time. Whether it's the right time to get in or not, I don't know. I don't know how long they're going to be down. I don't know if they're going to go down further, but I'm already in the soup. So when you're in the soup, you got to start stirring, you know. So there we go. So Pat says he is looking at UNH. So that's good. That was on my last video. I think UNH is good. I think the timing might not be very good. I do think they are a little bit overpriced, but so I mean it's a buy if I didn't have any, but with the amount of shares that I have, I'm not adding anything at this point for UNH. Incredible dividend growth company though, so we'll just have to see where they head. Let's see. Ex-dividend dad, ADP stock. And it's got a question mark. So I think the question might be, what do I think about ADP stock? ADP is ADP, automatic data processing. It's actually on my watch list. And, it's up there. I would say it is currently like number 8 in my draft. It's number 8 in the draft. I don't own any. I have it as a hold. And why is that? It looks like to me it's a good dividend growth company. It's right at fair value, has a relatively low dividend, and it's trading around $259 a share. So I think it's a great company. There's just nothing right now that screams buy for that stock for me. Sorry about that. I was on my tractor today, and I cut 8 acres of pasture. So my sinuses were just going nuts. So hopefully you guys can deal with all that. So ex-dividend dad also says about UNH, I'd hold off. Way to hay. I'm not sure what way to hay is. Anyway, I would hold off on UNH as well. Oh, way too high. I got it. Yeah, I think you and I are on the same page on that, ex-dividend dad. El Dynamico, how about, can you check SCHH? So I'm not real familiar with SCHH. I know it's one of the Schwab family. And here, let's put you on the screen. And I know you can't see it, Antonio, but that's I'll at least talk about what I see here. SCHH has a 3.08% dividend yield. It's got a nice dividend growth. So let me see what it says about it. It's a strategic trust. Wow. An exchange-traded fund launched and managed by Schwab. I know all of that. It invests in stocks of companies operating across real estate, equity investment trusts, which are REITs, diversified REITs, industrial REITs, office REITs, residential REITs, multifamily residential REITs. There's a lot of REITs here. It invests in growth and value stocks of companies across diversified market capitalization. The fund seeks to track the performance of the Dow Jones Equity All REIT Capped Index by using full replication technique. That sounds painful, actually. Wow, its dividend growth over the last 5 years is negative 1%. This past year, it raised its dividend by 37%. And over the last 10 years, the average is 6%. So it looks like it's got a pretty wild dividend payout pattern. Yeah, so that wouldn't be fun for my portfolio. I like for things to be pretty consistent. So so 3% yield and but a negative dividend growth. I don't know. That this doesn't excite me at all, Antonio. So those are my thoughts on that, my friend. Hopefully that's helpful. Yeah. So Michael's saying I question Lamb Weston's moat, and I think I agree with you. I mean, I think the challenge is well, first of all, they're the number one potato producer, French fry producer in the U.S. number 2 in the world. And their moat is really focused around being the lowest cost producer. And the way they do that is, as you know, potatoes can be very heavy. So their production facilities are located close to the growers. And, so they've got that going on. And it's been a capacity constrained environment. So where I may be somewhat agreeing with you is that if the world is changing and they're no longer going to be a capacity constrained environment, then I think they get relegated more toward a commodity, and therefore the moat kind of disappears. So I think the jury's out for me, but I certainly see where you're coming from, and wouldn't argue vehemently one way or the other at this point. I think we just got to see where this capacity goes. My guess is they're going to shut down some older plants and get that capacity back to being constrained again, because let's face it, that's the way that they're going to be able to manage and get the price that they want for their product, is if companies can't buy it readily on a commodity market. Yeah, I'm not sure what that means. Top 10 holdings, maybe. Top 10 holdings for SCHH. I can look that up, I think. SCHH. Let me do this. SCHH top holdings. Here we go. So they have Prologis. I don't remember how to say that. AMT, American Tower. They have Equinix. I think that is that's a REIT. I looked at them at one point, and so they're pretty heavy. Stay informed in just 2 minutes. They've got Welltower. That's number 4. They have Realty Income is number 5. Simon Property Group, number 6. Public Storage, number 7. Digital Realty Trust is number 8. Crown Castle, number 9. And Extra Space Storage is 10. And many of you are really interested in Vici. So Vici is actually their number 11. So, yeah, those are the top ones that they have. So it looks to be very, very focused on REITs. I don't know what PLD is. Let me take that out. Check it out real quick, because I just enjoy learning. It's an industrial REIT. Okay, gotcha. It's got a dividend safety rating of 61 and payout ratio of 83. That's not terrible for a REIT. But they've struggled with their dividend. Oh, well, I guess that was in the great financial crisis. Who can blame them? Who can blame them for that? But anyway, so there you go, my friend. Let's see here. Jim says, I did a Seeking Alpha health check on my portfolio. Yeah, I've seen those. And surprisingly, McDonald's dividend safety is fairly low. What does Simply Safe have to say about it? Well, why don't we take a look? We will look at MCD, McDonald's. They're at 77. So let's see if they've been at 77 for quite a while, especially since March of 20. So at least the last 4.5 years, they've been at a 77. So I don't see anything in Simply Safe that would say that there's anything weird going on with the dividend for McDonald's. So yeah, I'm not really sure. Let's take a look at Seeking Alpha and see what you're seeing. McDonald's. I mean, that's what this is about, right? Is learning. So let's take a look at their dividend. Dividend safety is a D-. That is wild. Payout ratio of 55%. That's not terrible. Let's see, cash dividend payout ratio. I think they're comparing it to the sector. And net long-term debt to assets is an F. Anyway, looks confusing to me. I'm not really sure. I don't invest in McDonald's. I like the McDonald's story. I like the fact that they hold a lot of real estate. There's a lot to like about McDonald's. The thing I don't like about McDonald's is they're everywhere, man. I was in China and ate McDonald's. I've eaten McDonald's in, here's a funny story. I was in Moldova. This has been, 1996. So almost 30 years ago. And they had a place called WAM, WAM. And it was the upside down McDonald's arches. So it was a W and it stood for We're Almost McDonald's. And I ate there and it was really good. So, I've had McDonald's in Romania. I've had McDonald's in Israel, and in Cairo. I don't know if it was in Cairo. It was in Egypt somewhere. I don't remember exactly what town we were in. But McDonald's is everywhere. So where's their growth going to come from? I mean, if you guys have any thoughts on that, I would be open to them. I just, I don't know where their growth's going to come in at. So I tend to stay away from Mickey D's from an investment perspective. Baba seems undervalued currently. I think they're under qualityed as well. Samar the gamer, maybe that's the way you say it. So I don't know if I've seen you here before, my friend. Good to have you. We'll see what just for grins and giggles. Let's just see what Seeking Alpha says about Baba. Alibaba. Yeah, they say they're undervalued as well, about 17%. So if that's something that you're interested in, it's certainly being traded at a fair price. So, don't let the price stop you. This is from Greg. Hey, thanks, man. Great video the other day. Have you pulled the trigger on V or Microsoft yet? Or are you still waiting? I'm still waiting. Visa, what did Visa do today? Like I said, I was on the tractor today, so it's a long day. Visa was pretty much flat. It was up 13 cents. Microsoft was up 79 cents. I think I will do it. I probably will pull the trigger this week, but I was just on the tractor, and it's just hard to conduct business when you're being bounced around, with a bush hog on the back. So, I didn't do it today, but hey, thanks, man. I really appreciate that. But I will be purchasing both of those more than likely this week. Let's see. Mr. or El Dynamico says thank you, and you are so welcome, my friend. Wow, Greg had a 4.4 earthquake at his house this morning. Hope everything's okay, man. I hope you didn't get rattled. No, that's I bet that's a little bit scary. So we have ex-dividend dad wanting to know about SNA. I think that's Snap-on, right? I don't have them on my watch list, so let's go take a look at SNA. So they're at a 17, according to Morningstar, they're at a 17% premium. What's interesting about that, though, is I think we'll see what this chart says. This is a price to fair value. So, I looked to buy SNA back in this time frame, and they were just really high priced. And well, as a matter of fact, they're still pretty consistent with where they've been. But I will say this: look at that fair value. The fair value is the red line. So Morningstar has been, while the price has stayed pretty consistent over the last 3 years, their fair value has grown to meet that. So, I mean, not meet it, but I mean, it's still overpriced according to Morningstar. But it's interesting to me how that fair value just keeps edging up. But I guess that makes sense. What does it look like here? Wow, they're 99 dividend safety. Dividend growth is 15%. Let's see what the 15-year is. I mean, the 5 years 15 also. Yeah, so I mean, Snap-on looks good. It looks to be a bit overpriced though, for my liking. Jim says he looked at the REIT as well as SCHH for his wife's ETF portfolio and went with SCHH. I think, if I'm not mistaken, it was the expense ratios that put SCHH over the top. There you go. Yeah, that's something else to look at. Michael says SCHH is going to be all REITs. Yeah, so Greg says he has everything's good. He just rode the wave. I bet that is really wild. I've been in earthquake before, but I didn't feel it. Everybody else did, but I did not, and it was not very big though. Nothing like what you guys get out there. Fast Eddie says McDonald's is a D- because the ice cream machine is always broken. That could be, man. I didn't think about that. I wish I'd thought about that. That's good, because that is definitely true. Jacob says, I wish I had a bigger vocabulary. So much I want to ask, but I don't know the words to use. I tell you what, buddy, you just throw them out there and we will work through the don't let any kind of vocabulary thing stop you, because I mean, what we're here for is to learn about investing, and sometimes we just use the words that we have. So that's all I'll say, buddy. Just throw it out there, man. It's all good. Yeah, so Frank says on a recession, people go to McDonald's. Yeah, that's right. But one of the unique things that McDonald's is struggling with right now is that their value meals are they can't get the cost of their value meals down so that the lower income people can come there and buy the value meals. So that's one of the struggles that they have, and that's one of the struggles then that passes on to Lamb Weston. Not to mention the fact that Lamb Weston has a capacity issue now. So it's not a good time out there for restaurants, at least for quick service restaurants anyway. On good times, people buy more McDonald's. Yeah, that's true. Loosen a few bolts and you got wham. Yeah, but I thought it was funny that it was in English, WAM, and it was because it's what is it? I forget what they call the alphabet in Moldova, but I think they call it Slavic, but it's the Russian alphabet. And but this was in English, WAM, and underneath it said, "We're almost McDonald's." Guess Mickey D's don't sell the McRib in Cairo. I did not see the McRib in Cairo. I did not. But I tell you what, after this was when was it? It was last year when we went to Egypt. Phenomenal trip. I would highly recommend it. But we flew into Cairo and we spent a night there. And went to, and maybe a couple of days, I don't remember. We went to the pyramids and the Sphinx and all that stuff. And then we got on a plane and flew down into the middle of Egypt. Luxor, I think, is the town that we flew into. Got on a boat there and floated down the Nile, and then floated. And then we went to see all kinds of stuff, and then we floated back up the Nile to Luxor, and then flew back to Cairo. So I tell you, after all of that, and this was like 10 days. So on about day 9, those French fries were really good. I mean, we were, I mean, the food was good on the boat, and so everywhere, we did not go hungry, trust me. But there was just nothing like a McDonald's fry near the end of that trip. So Jacob says he's a trader. If I look for low price stocks that have a good chance to rise in price. Yeah, I think that's what all of us look for. I tend to think of it as uh, how do I condense all that down? I I tend to think, or at least for my portfolio, I have three types of stocks that I look for. One would be a value stock, which is one that is beaten down. It is below its intrinsic value, and like Lamb Weston, and then buying that, with the belief and the trust that the management team can bring that back right over time. So that's one. The second one is, if I'm looking for yield. And like for instance, Hess Midstream is one of my yield companies, and so but it's also a dividend growth company. But the third one is dividend growth, and I'd love to take the time to kind of share how all of that works together. But we just don't have time to do it at the moment. But those are the three that I look for. There's also speculative. It could be. Some company that has this new technology or something like that is about to take off. So you could speculate. So, and there may be other categories. Those are the four that I think about. And I'm not opposed to speculative investments, but I don't have any at the moment. So, and I haven't had any in a while. So let's see. Pat says, it seems you buy and sell a lot. How much of your portfolio do you trade monthly? That's a great question. I don't know that I buy a lot. I don't know that I sell a ton. In the month of July, I sold a few holdings, and it's because of this, draft this draft model that I have. It was just basically saying you need to get out of these stocks, and one of them was IBM. So I sold IBM. I trimmed some Pinnacle West because it had grown to a place where I didn't need to be overweight on it anymore. What's another one? Cummins. I got rid of Cummins. And then I basically sat on that cash for a while. I don't see any others that I sold off. So I sat on that cash for a while, but in my income account, I needed to get that going. So I ended up buying UPS, which was in my mind a dividend yield stock. And so I'm looking to get that cash redeployed. I think I got up to 6% cash in the portfolio, and I'm okay going up to 10%. But it's I really want the portfolio to stay invested. So now I'm down to maybe 90, about 4% cash. So I'm about 96% invested. So anyway, I play around with a little bit of cash, Pat. So it probably sounds like I trade a lot, but I really don't. I keep at least 90% of my portfolio invested all the time. And so I usually, and I'll probably go up to 98%. So I usually have maybe a 4% swing there that I'll trade around. But it's not a ton. It's not a lot. So I know it probably sounds like it, but it's not. Maybe it is. Tutomi, welcome, man. I haven't seen you in a while. Then he put on Gilead. So yeah, Gilead. I liked Gilead, and I don't remember why I didn't buy them. It's been a while since I looked at them. So let's take a look. GILD. Gilead Sciences got a 70 as a dividend safety rating, 4.2% dividend yield. So that's not too bad. I think I know what it is. I tend to not hang around too much with pharmaceuticals and stuff. because I'm just not smart enough to know what pipelines are going to win and what pipelines are not. So I tend to stay away from those. I could probably invest the time, but it just doesn't interest me a lot. So I don't know. I tend to stay away from it. At one time, I was interested in Gilead, but I ended up not buying it. And so there we go. Let's see what it's just for grins. Let's see what it's trading at. That's Prudential. Yeah, it's at a 24% discount, so it's certainly well discounted still. So, yeah, I just don't know. You know, some stocks, you know, if a drug hits, then boom, you know, it'll shoot up. But I don't know, man. Hey, Janice, welcome to the program, bud. It's good to see you. Is WBA a value stock then? I would say yes, it is. Let me just do a real quick. That's Walgreens Boots Alliance. So yeah, it's trading at a 54% discount. So yes, it is a value stock. But it doesn't mean it's a value stock that I'm interested in. So that's part of the process that I go through. You guys are very, very familiar with it, but it's my 5-step process where I look at the financials, I look at the capital allocation, the valuation, the strategy, and the management team. And if things kind of flow through those 5 things, then they go into this model where I try to rank my value stocks and dividend growth and dividend income to see what is the next best investment out there. So, yeah, so it is technically it is a value stock, but it's not a value stock that I'm interested in. If that makes any sense. Oh, here we go, Jim. Little known fact about the McRib: it was designed for the McRib used. The design for the McRib used new technology for restructured meat product. Oh, wow. Created by Richard Mandigo, the University of Nebraska. Go Huskers. So restructured meat product. Yeah, it's kind of like the chicken nuggets too, right? They're kind of restructured. Yeah, I'm with you, Fast Eddie. I don't like the sounds of a restructured meat product. I like meat, and I like it just to be natural, just the way it's supposed to be. Let's see. See if there's anything of interest. Yeah, Pat says, answering to Russ, if Walgreens is a value stock, MPW is as well. I'm not sure if Morningstar covers MPW, but let's see if they do. No, they don't. But it does say the fair value is 6.47. So technically, it also they do say it is fairly valued, but that's like a 50% decline. So, but anyway, it's just fun stuff, right? I don't plan to invest in MPW anytime soon. Greg says mechanically separated meat. That's exactly right. Yeah, this is a great point, and I think it's the one we'll end on. We're an hour and 4 minutes in now, but Russ makes a great point. The best buys can come when companies are beaten down by short-term news. I don't think WBA is short-term news, though. I think that is 100% right on the money, because at the end of the day, what we are looking for is for the market to be beating down a stock that and maybe it deserves to be beaten down in the short term, but I will say this: there are a multitude of investors out there, and all of those investors have varying goals and desires. So you might have day traders, for instance, and those are looking for stocks that they can push up or stocks that they can push down and sell short. So they're looking for that short-term gain. This is just an example. And, you got long-term investors like me, and if they're pushing the price of those shares down, that, in the long run, it's a great deal. I just have to wait for it. Then that's kind of what I like to do. So, and I thought I had done that with Lamb Weston, but I was too early to the party on that one. Okay, Billy, I said that Russ would be the last one, but I can't pass up my man Billy. He wants to take a look at CVX, which is Chevron. And I will say I watched the Morningstar video today, and they recommended Exxon. So, but I did not look at CVX. But let's take a look. It's all good, man. So let's start here. I like Seeking Alpha. I like what is this called? Simply Safe Dividends, because it kind of keeps everything together. It's really easy to look at. 4.5% dividend yield. They're trading at around 145. I remember them being up around 190. I think that's where I sold them at last year or 2 years ago, maybe. They were blowing and going, man. They've got a 90 very safe dividend rating. Back in 21, they were at a 65, so it wasn't as good. Payout ratio is around 50%. Got a 6% 5-year and an 8% latest dividend raise. 36 years of dividend growth and 112 years of dividends being paid. So pretty solid. Those graphs look a little weird. Return on invested capital finally is looking pretty decent at 12%. So we like that. Debt to capital is very low and interest coverage is very high. So, things are looking a lot better at Chevron than they were earlier. Let's see what Morningstar says about their fair value. They say their fair value, they're trading at an 18% discount. They're trading around 145. They're saying that their fair value is 176. I will say, though, let's take a look at their chart, and let's go kind of a long term. Let's look at 5 years. Let's look at their max. You can see how cyclical they are, though. I mean, look at this up and down, up and down, up and down. So I think you want to try to find that in the down pattern. So it's, I'm not investing in Chevron. Let's take a look at Exxon just really quick. Exxon Mobil. They're at a 14% discount. I wonder why they recommended Exxon over Chevron. I'm not really sure, but let's take a look at Exxon as well. Their max. You can see here very cyclical as well. But again, both of these are kind of at a peak. And so I think I'm staying away from these for the moment. And we'll just see what happens. Let's see what Exxon is over here, just for grins. It's an 80. Wow, that's pretty good. Dividend yield of 3.19. So let me see if there's anything else here. Yeah, hit that like button. Thank you, Jim. I appreciate you mentioning that. And thank you guys for joining. All right. I think that's it, guys. I enjoyed it. Let's do it again next Monday. I'll have a video coming out on Hess Midstream, as well as the next installment of my top. I think I'm going to do the top. I did top dividend growth. I'm going to do the top value plays in my next video. So with that, I'll see you guys next week. Have a great week in the market, guys.